Hello guys, Brandon here. We're on site at a 10-bedroom triplex on Airbnb and VRBO, crushing it. It is a cash machine. The strategy the investor uses is brilliant. He can rent it as a 10-bedroom castle. He can rent it as a 4-bedroom, 2-bathroom. He can rent it several different ways, and because of that, he is making a ton of cash. Now guys, I'm going to take you all through this property, and you want to watch this video if you're a first-time investor, if you're a seasoned investor, because it could be the difference in you making profit or not on your next commercial investment. Let's get into this multifamily property right here in Surfside Beach. Now guys, I'm going to cover gross rental income, operating expenses. We're going to dive all into the numbers and do a complete financial analysis on this property. So you don't want to miss it. Let's get into the video now. All right guys, let's check this property out. First, the outside. As you can see, it is gigantic. I'm going to show you around real quick around the area. You can see, very, very nice. Surfside Beach, you can see the ocean. That's the beach access there. See that little spot right there, beach access? It's literally right across the street. As you can see, surrounding areas are great. Properties are phenomenal all around this thing. It's a good area. Now, I'm going to take you around here. First, I'm going to show you there's room to put a pool in on this property, which again is value add, especially for short-term vacation rentals on Airbnb and VRBO. Now, there is a pool. There is a pool on site and an elevator, which is absolutely phenomenal. As you can see here, I'm going to get around back. There's an elevator for carrying up your luggage up those 3 flights. That's pretty cool. I think it's a nifty little feature. Fire pit, there's outdoor furniture and stuff, as you can see. And there's a pool. Check it out. Not bad, right? This one feature shows up phenomenally in Airbnb listings and VRBO listings. It adds a lot of appeal for tourists wanting to make sure they get the most for their vacation. Now you can see here, there's parking underneath. I'm going to carry you upstairs into the first unit, and then we're going to check out the gigantic balcony that overlooks South Ocean Boulevard. Let's get inside, guys. Now, as soon as you come in, immediately to the left, we have the kitchen. We do have 2 rooms on the left side, 2 rooms on the right side, and plenty of space in between, as you can see. Check this out. Nice tile, range, dishwasher, microwave, sink, everything you need for a vacation, guys. Let's check out the first bedroom. Bingo. Dual vanity, Jack and Jill. Connects to the other. Now, back behind this door, we do see the shower and the restroom, of course. The next bedroom, as you can see, we're going to cut right across the way. We're going to hit that balcony in just a minute. As you can see, plenty of space, plenty of room. Another dual vanity. Tub shower combo. Again, Jack and Jill coming right into the other bedroom. Now, let's check this out. Plenty of space up here. Look at that, guys. And that is your South Ocean Boulevard view. And those are guests that are staying here, heading over to the beach access, doing what tourists do when they're vacationing at the beach. Now, there is another unit right up this way. If we take the stairs down, it takes us down to the first floor, to the parking area. And there's another unit up this way here. Now this is going to be the balcony on the second unit. Again, we'll come out that door in just a minute. But you can see it's pretty spacious. And of course, has a phenomenal view of Surfside Beach. I'll take you up just to see Unit 3. Although we can't get into it. Can't see the pool there. Space. Because there's tenants in it. But I do want to show it to you. Just a little bit. As you can see, super cool, very nice. We're at Unit 3. Now let's go downstairs and get into Unit 2 so you can check it out. Getting the cardio in today, come on. We're going to come this way this time, guys. So you can see the courtyard space. Fire pit. Nice deck with a table. Another deck with table, and we're at Unit 2. Let's get in Unit number 2. So as soon as you walk in, wide open spaces. You've got 4 rooms, space in the center connecting all 4 rooms. Immediately to the left, we do have our kitchen, very, very similar to the last unit that we went in. You can see same layout, stove, microwave, a refrigerator, range, dishwasher. Our first bedroom. 2 double bed, 2 beds, dual vanity. Nice natural light coming in from the center of that window for the dual vanity. Shower. Jack and Jill connecting to our next bedroom, as you can see. Flat screen TV. Closet. We're going to get to that balcony in just a minute. Another large spacious room, dual vanity, very nice, nice flooring. This is going to be an actual tub shower combo, as you can see. Double beds. Now, they've got the game set up in the middle of the room, which is phenomenal. Flat screen TV, as you can see. And of course, a massive and expansive balcony right here. Not bad. Not bad at all. All right, guys, that wraps it up for Unit 2. All right, so let's talk through some of those numbers right here at 510 South Ocean Boulevard. Guys, he rents this out 3 different ways. He rents it out as a 10-bedroom. It can sleep up to 28 people that way. Now, if he rents it as a 10-bedroom, you'll see the total income he made in 2024 was $220,356.52. Now, on Airbnb, he made $146,547.52. On VRBO, he made $59,109. For total private credit, he didn't make anything renting it as a 10-bedroom. And then for total private cash, he made $14,500. Again, all of that was renting it as a 10-bedroom. You'll see that if you add the total Airbnb and the total VRBO up, along with the total private and the total private credit and total private cash, it will give you that $220,356.52. So that's what he made renting it as a 10-bedroom. You can obviously see that the more rooms that you add on to a short-term vacation rental, the more upside you can make in a deal. Now, when he rents it out as a 4-bedroom, 2-bathroom, that's Sea Dreams Unit 1. For total income, he made $15,354 at 91. $9,746.91 was attributed to Airbnb. $1,596 was attributed to VRBO. Total private credit was $2,422, and then private cash was $1,590. Now, Sea Dreams Unit 2, he made a total of $14,449.17. Renting it on Airbnb, he pulled in $11,925.17. Renting it again as that 4-bedroom, 2-bathroom, he made on VRBO $2,135. Total private credit was $389, and he didn't make anything with total private cash. And then finally, the Ocean View Penthouse. We've got $24,614.55 he made in total income for that, total gross rental income. $16,991.55 was attributable to Airbnb, while $3,268 was attributable to VRBO. Total private credit at $2,415. and total private cash at $1,940. You can see the total income he made for 510 South Ocean Boulevard right here in Surfside Beach was $277,775.15. Now, between this property and the other unit he has at 412 Seaside Drive, guys, he made a total of $405,936.08. Guys, $405,000 between two properties. Is it smarter to buy one oceanfront or several oceanfront condos, or buy a multifamily property, or buy two multifamily properties? Well, for several reasons, which we'll cover in this video, you'll understand that buying a multifamily property is the route to go if you've got the capital for it. Before we move on, I want to take a moment to tell you that Airbnb is the clear winner when it comes to short-term vacation rentals in the Myrtle Beach market. You can see here, he pulled in $248,909.08 off of Airbnb, renting two multifamily properties, versus $106,212.27. Yes, you can make money on VRBO. Yes, you can make money on Booking.com. Is it smart to be on all of them? Absolutely. Where is your bread and butter going to come from? Airbnb. Let's take a moment to explore the total private credit and total private cash for 510 South Ocean Boulevard. Guys, $5,226 and then another $18,230. We're talking $23,000 in gross rental income that he would have missed out on if he didn't market this to his sphere of influence. The sphere of influence, guys, is that's all those Facebook posts, Instagram posts, TikTok posts, YouTube videos. It's getting the information out in front of your network, and there's additional capital that you will make on your short-term rental if you will just market to your sphere of influence. Now, if you don't have a great sphere of influence, can you still be successful on Airbnb and VRBO and all of these other websites? For sure, yes. But if you market to your network and you have a strong sphere of influence, that could be a great indicator that short-term vacation rentals in the multifamily market would be a wise investment for you. And just take into account the oceanfront condo owner at the Caribbean who had a 1-bedroom, 1-bathroom and made $72,000 in gross rental income off of her one unit. When asked how she did it, she marketed it on Instagram. It's clear to me, in my opinion, that she had a strong sphere of influence that she had influence with. She had a strong sphere of influence that she could put her property in front of and pick up rentals from. Now, can you go on Airbnb alone and market it, VRBO, and these websites? Absolutely. Will you still be successful? Absolutely. I had a client who had a 3-bedroom, 2-bathroom over at Sand Dunes Resort. He made $63,000 his first year ever doing this, just on Airbnb. He wasn't on VRBO. I don't believe that he marketed to his sphere of influence. He didn't say that to me. That was it, first year off the gate. So yes, you can be successful. However, do you want to make 20 or 30% more gross rental income by putting your property regularly in front of your sphere of influence? Absolutely. So don't miss out on the extra income. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. Now, guys, this intersection is just up from the beach house. As you can see, there's plenty of traffic. It's pretty busy. There's also a lot of little stores and shops and stuff here that are phenomenal. If I can get through some of this traffic. As you can see here, we're kind of coming to a nice little area. Restaurants restaurants, little things to do. And it's literally just up from the property. Again, this is what the surrounding area looks like. So you can see it is a great area. People out on bikes. This Fuller Park right there. Nice little park. There's a little local event going on. You can see people with tents set up and they're selling stuff. So very family friendly area. There's Tide Law Firm right there, where a lot of my clients close their deals. Anyways, Surfside Beach is a family friendly area and a great area. It's known as the family friendly beach. You got River City right over there. You got the Surfside Beach Pier. See the pier there. River City Cafe there. You can see people and places all over the place, and it's March. And guys, that is how close we are to these rental properties. Right through this next intersection, and we're here. All right, guys, so let's go over the numbers for 510 South Ocean Boulevard. Now, this worksheet is called the cash flow analysis worksheet. There are several sections to this worksheet. Don't get overwhelmed by it. As we break them down section by section, it'll make sense. It'll be simple and easy for you. Now, I'm going to draw your attention to the top portion of the worksheet on the right side. It's got your purchase price at $1.85 million. We have acquisition cost of $74,000. Most likely, that's mainly going to be your broker's fees. Most likely your seller is going to split that with you, 2% and 2%. I've got you at a 4% total fee. Your loan cost, we've got you at $27,750. That's your entire loan cost. That's 2% of the mortgage amount for the loan. Again, that's going to be amortized over 5 years if you own it for 5 years, which we'll get into in just a minute. But the whole purpose of this section is to figure out what your initial investment is going to be. So you've got those loan cost fees of $27,750. You've got a mortgage at it's $1,387,500. That is roughly 75% of that purchase price. So, hence you're paying 25% down on that loan, and that's your outstanding balance. Now, if you take the purchase price of $1.85 million, you add in those acquisition costs, you add in those loan costs, you take out the mortgage, you're left with your initial investment of $564,250. That's the money out of your pocket to get into this deal. Now, the next section down is the mortgage data. Your amount again was $1,387,500. I've got you at a 7% interest rate. It could be less, it could be more. I've got you amortized over 25 years with a loan term of 5 years, 12 payments per year. You're having a periodic payment of $9,806.56. Your annual debt service comes out to $117,678.72. And then again, your loan fees and costs total $27,750. Again, that's 2% of your mortgage. All right, this is where it starts getting juicy, guys. This next section of the worksheet is the taxable income section. So for potential rental income, if this property was rented 100% of the time, 365 days a year, it could make $422,700. Now, we've got you at a vacancy and credit loss, a vacancy rate of about 35%. In other words, this property is rented 65% of the time. The occupancy rate is 65%, but we do have to account for the time it's not rented and that lost income. So your vacancy on this was $147,945. Now, if we take the $147,945 from the $422,700, we're left with $274,755 for the effective rental income. That is how much this property made just last year. Now, other income, collectible. Now, that's going to be if, let's say that your property had signs on it that you were renting out, advertising, let's say that you were paying for parking, you had paid parking, there's all kinds of ways to gather other income. On this particular property, there is no other income, so I have a 0 there, bringing you down to a gross operating income of $274,755. Your operating expenses, we have you at 35% of the gross operating income. That is $96,164. If you take the $96,164 from the $274,755 gross operating income, you are left with a net operating income of $178,591. Now, your interest. Keep in mind that the purpose of this section of the worksheet is for taxable income. We want to know how this is impacting your taxes. When you have that frame of reference, this will all make sense. Now, your interest for the first year was $96,453. That is the total amount of interest that you'll be able to write off for year one. Now, cost recovery. Basically, guys, we're at $44,924. I'm going to walk you through the process of how I reached that figure. And it's very important that you have a defendable basis for your argument in how much you are depreciating your property. And let's cover that right now. Now, guys, I get calls and emails all the time from investors just like you looking to find the right investment, the best deal with the highest return on their money. Happens to me all the time. Don't be a stranger. Don't be afraid. Pick up the phone, give me a call, shoot me a text message, send me an email so that I can run your numbers, be your boots on the ground, your hands on the ground, and do all the legwork that you need to get done to make a savvy investment decision. Don't trust this kind of decision to just anyone. You need an investor broker that specializes in working with commercial real estate investments to run the analysis on your deal. I don't care if it's a short-term vacation rental property like this right here. Maybe it's an oceanfront condo. It could be a multifamily property, a retail property. Whatever it is, don't trust it to an average run-of-the-mill agent that doesn't specialize in doing investment analysis for their clients. You need somebody that is solid and professional, that answers the phone when you're available, whether it's 9 o'clock at night, 12 o'clock. I mean, when I say I'm working on deals all night long. I've got investors that are, overseas calling me at 9 o'clock at night. We're working on stuff, getting it done. I mean, that stuff is normal. It's routine history for an investor broker because I'm used to catering to these type clients. So if you need someone that's professional, that's going to run sound analysis for you and give you the insight that you need to make a savvy investment decision, then don't look any further. Give me a call. It's 843-360-1737. Again, I am an investor broker and I specialize in working with investors just like you. Now, I don't care where you are in the process. If you're 6 months, out, you're 3 months out, you're 2 years out. I don't care where you are in the process. Don't let fear hold you back. If you're considering investing, taking money out of your 401k, I've got an appointment Sunday with an investor. He's got $300,000 in his 401k. What does he want to do? He wants to buy solid commercial investment properties and investment properties that he can get a profit for. Many times people will have money in their 401k and it's simply not enough for them to retire off of. And they need to be investing that money in hard assets like passive income producing real estate that is going to make you the kind of return in both appreciation, tax write-offs, and annual profits from renters. That's what you need, guys. And to be honest with you, short-term rentals happen to have that sweet spot in the market where they give you a little bit of that upside of the stock market without all that risk. If you want more information on that, you can see many of the videos on my channel. Pick up the phone, give me a call, and let me help you make a savvy investment decision. 843-360-1737. So in order to come up with a defendable basis for the cost of recovery or depreciation aspect of what we wrote off each year over the life of the investment, we basically went to the courthouse records and we pulled the tax assessment. You can see on your screen there that the total tax appraisal for this property was $931,130. We took the appraised improvements, which was $623,900. We divided that by the total tax appraisal, that $931,130, and that gave us 67%. In other words, the total improvements are 67% of the total tax appraised property. So we use that as the defendable basis for how we can depreciate this property each and every year. So after we arrived at the 67% depreciable basis, we took the $1.85 million purchase price, we added in the acquisition cost, your brokerage fees of $74,000. That gave us a total of $1,929,000. Now we took that as the original basis of the property and we multiplied it by that 67% in order to reach our depreciable basis. That's $1,289,080. Now, we calculated our depreciation each year. Year one, you'll see that $1,289,080. We multiplied it by a acquisition percentage in order to come up with your $44,924.44. Now, let's cover some of these assumptions. There's, the IRS gives us these tables, and we can use a certain depreciation percentage for non-residential properties as well as residential properties. So basically, I've grabbed those IRS tables, and there are a few assumptions here, and I'm using those tables to calculate your depreciation. Our assumption is that we've bought it in the year of acquisition, year one, we're only going to be depreciating the property 11.5 months. In year 2, 3, and 4, we're depreciating the property 12 months. And then finally, in year 5, we're going to assume that we're going to only depreciate the property 11 and a half months. This takes into account what's called mid-month convention, and it gives us, it allows room for, hey, we sold the property, so we didn't quite collect one full month depreciation in both the acquisition year and in the disposition year. Now, you can see all those numbers played out. Your year 2, 3, and 4 numbers, you came in at $46,870.95. And then finally in year 5, you're back at that $44,924.44 for a total depreciation of $230,461.73. And guys, you can kind of see I did this back of the napkin math here. You got it on your screen to calculate these numbers. So if you look back on your screen, you'll see that taxable income section of the document. Under the section, it's line 11 where it says cost or recovery improvements. That is the depreciation calculation that I have ran for this property, owning it over 5 years. And you can see all those numbers there. Now, I do want to backtrack really quick to your interest and just show you how I calculated those interest payments. Again, your payments per year were 12. Your amortization period was 25 years. Your loan amount was $1,387,500. Your annual interest rate 7%. Your periodic payment $9,806.58. Your annual debt service $117,679. You'll see year 1, 2, and 3. We've got our beginning balance. We have our interest. We have our principal, and we have our ending balance. Essentially, I ran these numbers and took all of those interest payments for year 1, or those total amounts of interest, the annual summary for interest for year 1, 2, 3, 4, and 5, and plugged them right into our worksheet so that we knew exactly how much we could write off in interest each and every year. That simple, that easy. All right, moving right along with the rest of these numbers here. After we've calculated our cost of recovery on our improvements, we're going to move right down to line 13. That's the amortization of loan fees and cost. Essentially, it's that $27,000, I think it was $750, 2% of the mortgage amount spread over the life of the investment. So for our purposes, we're planning to own this property for 5 years. That's $5,550 per year. Each and every year that we own the property, we can write off for our loan cost and fees. Now, we're going to take our net operating income. That's line 7. We're going to subtract out our interest payment. That's line 8. We're also going to subtract out our cost recovery, because we're not paying taxes on the interest. We're not paying taxes on the cost of recovery improvements. We're also not going to pay taxes on our amortization of loan costs. And essentially, that's going to give us our line 15, real estate taxable income. Now, line 16 is going to be 37% of line 15. I'm just assuming you're in a 37% tax bracket. Your tax bracket may be different. I did that for our assumptions here. So that $11,716 is your tax liability in year 1. Now, just a little quick housekeeping note. Essentially, I have escalated your potential rental income and your operating expenses by 2% each year. Outside of that, all of this math is pretty much self-explanatory. Your interest payments I've gone over for all the years. We're assuming that you're going to own this property for 5 years, and in the 6th year sell it. That simple, that easy. All right, so let's talk through your cash flow, the cash flow section of the worksheet. You have your net operating income in year 1 of $178,591, your annual debt service of $117,679. If you take your annual debt service from your net operating income, now keep in mind, this is cash flow. This is the actual cash hitting your hands. You're left with cash flow before taxes of $60,912. Now, if you take that tax liability that we just calculated, the last line of the last section of the taxable income part of the worksheet, that $11,716 from your cash flow before taxes, you take the $60,912 cash flow before taxes, you subtract out the $11,716, you are left with a cash flow after taxes of $49,196. Now, you can see each and every year as the net operating income increases, respectively with the 2% increase. Again, I'm accounting that due to inflation. You're obviously next year you're making $51,599. It goes up a little bit more, $53,000 in year 3, $286. Year 4, $54,974, and finally year 5, $55,942. So guys, Those are the cash flows that are actually hitting your hands each and every year after you make this investment. Now, moving right along, let's talk through the alternative cash sales worksheet. Now, guys, your first scenario, there's 3 different scenarios on this spreadsheet. And essentially, this is kind of looking at the property at varying cap rates to see how much you could make off the investment for your sales proceeds after tax once you've owned it for 5 years and you sell it in that 6th year. Now, in your first scenario, we've got a 9.7% cap rate. Now, that's the current cap rate on the property. So what I'm saying there is, this is the scenario. If all things stay the same, this is how it plays out. If the market doesn't get any better and doesn't get any worse. Now, the next the next scenario, or the one in the middle there, that's at an 8.7% cap rate. Let's say that things improve a little bit. Let's say that Myrtle Beach has been the fastest growing market for the last 3 years in a row out of the 150 most populated markets. That is a fact. And we had over 90,600 people move to our market just last year. So, appreciation, in my opinion, we are looking good for the next 10 years, next 5 years, as we've had a lot of growth in our market. So I would imagine it's safe to say that property values are going to continue to increase in our market. And if they do that by just a 1% cap rate increase, that's our scenario and how it plays out. And then finally, that third column there, that's how it plays out at a 7.7% cap rate. Let's say that things do even better than just get better by 1% cap rate increase. Let's say that, that cap rate drops even lower to a 7.7% increase. And so we're going to look at these 3 different scenarios for this property. Now, there are 3 different calculations on this worksheet. The first one is calculating the adjusted basis. Now, our basis at acquisition was that $1,924,000. That is essentially the purchase price plus the acquisition cost. Now, we took cost recovery in the total amount of $230,462. If we subtract out our cost recovery, we're left with an adjusted basis at sale of $1,693,538. Now, at a 9.7% cap rate, our sales price in year 6 is going to be $2,032,773. Essentially, we took the year 6 net operating income, we divided it by the 9.7% cap rate to arrive at that sales price. Now, the cost of sale in year 6 to sell it, let's say 4% of the sales price, those are your brokerage fees, of $81,311. Your adjusted basis at sale, which we already calculated in line 5, we just shift that on down to $1,693,538. We're shifting that down from line 5. Then we're going to calculate our gain. Essentially, we'll take our sales price, we'll subtract out the cost of sale, we'll subtract out the adjusted basis of sale, and we will be left with the gain or loss. In this case, it is a gain of $257,924. Now, we're going to take our straight line cost recovery, which we've already calculated. That's our total depreciation that we've written off on this property after owning it for 5 years. And that is calculated right there on line 3. We're going to drop that down, and that's $230,462. If we subtract $230,462 from the gain that we made of $257,924, we will be left with a capital gain from appreciation of as much as $27,462. Now, next, we're going to factor in the unamortized loan cost. Now, that's $27,750. Over 5 years, we wrote off 2% of the mortgage, which were the loan fees and loan cost. Next, we're going to have our ordinary taxable income, guys. So essentially, we'll take the capital gain from appreciation of $27,462. We're going to subtract out the unamortized loan fees and cost of $27,750, and we will be left with a negative $288. Essentially, we don't have taxable income. We're in the clear $288, which is phenomenal. Now, the last portion of this spreadsheet is going to be the calculation of sales proceeds after tax. Now, our sales price was $2,032,773. Our cost of sale was $81,311. That's those brokerage fees. Our mortgage balance, we got to pay it off after owning it for 5 years, was $1,264,875. So if we take our sales price, subtract out the cost of sales, subtract out the mortgage balance, we're left with the sales proceeds before we pay taxes of $686,587. Now, our tax savings, our ordinary income at 37% of line 16, which we've already calculated was a negative $288, is 37% of that, assuming you're in a 37% tax bracket, is a negative $106. Our straight line recapture, which is 25% of line 11, was $57,615. That is the recapture tax that when you sell this property, you're going to have to pay the IRS for them giving you such a great write-off on your cost recovery on your depreciation. Now, your tax on capital gain was 20% of line 13. That's $5,492. And then finally, you have, again, that is a recapture tax as well. Because you had such great capital gains, such great appreciation on that property, they are going to want a piece of that, and they're going to want 20% of what you made. And then finally, you have your sales proceeds after tax of $623,586. Essentially, you take your sales proceeds before tax, you subtract out your tax savings, you subtract out what you're going to have to, so you're paying those tax savings. In this case, it was negative. You're paying your straight line recapture at 25%, which is $57,615. You're paying what your capital gains recapture tax, which was $5,492. If you subtract all those from that sales proceeds before tax, you're left with $623,586. Guys, you have got $600,000 in your pocket if this property doesn't improve at all and just stays the same. And in my opinion, in our market, we are positioned very, very well for this property to appreciate and grow in value. So let's cover those scenarios now. Now, I'm going to give you the quick hand or straight hand version of this. At an 8.7% cap rate, that sales price goes to $2,266,425. It was previously at $2,032,773. Essentially, we have increased the value at which we can sell that property at in year 6. If it sells at an 8.7% cap rate, I'm just going to, basically all of your numbers are just about the same except for your gain on the property. Your gain goes from $257,924 to $482,230. Now you were walking away with a capital gain from appreciation of $251,768, as where before it was $27,462. Now, if you keep working through the math there, you'll see towards the bottom of it the sales proceeds after tax. If you've got that $2,266,425 sales price, you got 4% brokerage fees that you'll have to pay, which is the cost of sale, $90,657. Then you got that mortgage balance. You bought it at the same exact price that you bought it in the previous scenario, so the mortgage is going to be the same. It's $1,264,875. Now you're left with a sales proceeds before tax of $910,893. Guys, that is a whole lot more cash flow than what you had last time. Your cash flow before taxes of $686,587. Now, your ordinary income that you'll be taxed on at 37% was $82,887. Your recapture for cost to recovery was $57,615. Your capital gain has now increased. It's $50,354, and so that's going to leave you with the sales proceeds after tax of $720,037. So if the market does a little bit better, you can see you're walking away with $700,000. Now, finally, at that 7.7% cap rate, your sales price jumps to $2,560,766. Guys, We're just going to jump straight down to the last calculation, the calculation of sales proceeds after tax at the bottom of the spreadsheet. With a 2.5 sales price, you've got a cost of sale of $102,431. You've got that mortgage payoff of $1.2 million. You're left with sales proceeds after tax of, sales proceeds before tax of $1,193,461. Now, we have to pay our ordinary income at 37%. That's $187,437. We have to pay our 25% recapture tax on depreciation. That's $57,615. We also have to pay our recapture tax on capital gain at 20% of $106,867. We're left with, once we take all of those things out of the sales proceeds before tax, we're left with $841,541. That's at a 7.7% cap rate. Guys, our market is blowing up with people moving here. I seriously doubt that the 20 to 22 million tourists that rent our oceanfront condos and our short-term vacation rental properties in our market are going to stop showing up. People have been visiting Myrtle Beach for years and years and years. I mean, like since the 1930s. It is the value, it's mainstream America. It is the value investment when it comes to a vacation rental market. This is where people go to get a good deal, not spend a ton of money. This is where your families come. This is more centrally located, so it attracts a very large crowd. In my opinion, this property is positioned to make a whole lot more in appreciation in the coming 5 years. All right, guys, and finally, you've got your net present value. I want to cover this with you, and the hurdle rate is at 12%. Your IRR, your internal rate of return on this was 13.53%. Guys, I want to cover these numbers with you. Your initial investment was $564,250. You've got your cash flow after taxes every year listed there, which we've already gone over. And then finally, I've ran this in the middle scenario. Let's say that you have an 8.7% cap rate. So it doesn't stay the same. It improves just a little bit, but not as much as we looked at that it could improve. So you sell it in year 5 at $720,037. Guys, you're still, based on the net present value, with a 12% hurdle rate. If you've got to get 12% return on your investment, well, guys, you're getting it, plus you're in the clear, $33,986. In other words, you could technically pay $33,986 more for this property and still come out making that 12% hurdle rate. Your IRR was 13.53%. Come on. It doesn't get much better than that.